In the world of finance, reputations are built over decades, and they can collapse in a matter of days. In the world of crypto, that collapse happens even faster. Few stories illustrate this truth better than the rise and fall of Sam Bankman-Fried and his company, FTX. Just a few years ago, Sam Bankman-Fried was the darling of the crypto world. He was seen as a visionary who could bridge the gap between traditional finance and the digital future. At his peak, he was worth over $20 billion. His company was valued at $32 billion, and he was rubbing shoulders with politicians, celebrities, and investors who trusted him with their money and their reputations. But in late 2022, everything came crashing down. FTX imploded in one of the most dramatic financial collapses in history. Billions of dollars vanished, hundreds of thousands of customers were left stranded, and Sam himself went from crypto king to convicted criminal. This is the story of how FTX rose so high, fell so fast, and what we can learn from its collapse. The making of a crypto prodigy. Sam Bankman-Fried, often called SBF, was not the typical image of a billionaire CEO. Born in 1992 to two Stanford law professors, he grew up in a world of academics, logic, and math. He studied physics at MIT, but what really defined him was his ability to think in probabilities. He was a devotee of effective altruism, a philosophy that suggests earning as much money as possible so that you can donate most of it to causes that will help the world. After graduating, Sam joined Jane Street, a prestigious Wall Street trading firm, where he specialized in arbitrage strategies. Arbitrage means taking advantage of price differences across markets, and Sam discovered that in the early crypto world, there were massive opportunities. For example, Bitcoin might trade for $10,000 in the US, but $11,000 in Japan. By buying low in one market and selling high in another, he could pocket the difference. In 2017, he founded Alameda Research, a trading firm designed to exploit these inefficiencies in crypto markets. Alameda quickly made millions, building Sam's reputation as a brilliant and aggressive trader. But trading alone wasn't enough for him. He wanted something bigger, a platform that could dominate the global crypto exchange business. The birth of FTX. In 2019, Sam launched FTX. Unlike many of the existing crypto exchanges at the time, FTX was built with professional traders in mind. It offered complex products, derivatives, futures, leverage, and risk management tools that weren't available elsewhere. In an industry filled with clunky platforms, FTX felt sleek, modern, and designed for serious money. The company grew at lightning speed. Within 2 years, FTX became one of the top exchanges in the world, competing with giants like Binance and Coinbase. Venture capitalists rushed to invest. Sequoia Capital, one of Silicon Valley's most respected firms, poured in money. SoftBank and Tiger Global followed. Even celebrities got involved. Tom Brady and Gisele Bündchen became brand ambassadors. Steph Curry joined as a global spokesperson. FTX logos were everywhere, on stadiums, on TV ads, even in Super Bowl commercials. By 2021, FTX reached a peak valuation of $32 billion. Sam himself was ranked among the richest people in the world, and he was only in his late 20s. He donated tens of millions to political campaigns, met with lawmakers in Washington, and became one of the most powerful voices in shaping crypto regulation. He cultivated a carefully crafted image, the scruffy genius who didn't care about luxury, who slept on beanbags at the office, and who played video games during meetings. Investors and politicians alike were enchanted by the story. Here was a young man who seemed to care about nothing but math, probabilities, and making money to give it all away. The cracks in the foundation. But beneath the surface, the empire wasn't as solid as it looked. FTX and Alameda Research were supposed to be separate entities. On paper, FTX was the exchange where customers traded crypto, while Alameda was an independent trading firm. In reality, the two were deeply entangled. Alameda was taking huge risks, borrowing money, making speculative bets, and trading with leverage. When Alameda started losing money, Sam secretly used FTX customer deposits to bail it out. Billions of dollars that customers thought were sitting safely on the exchange were actually being funneled into Alameda's risky positions. This wasn't just a bad business decision, it was fraud, and it created a situation where FTX's balance sheet was a ticking time bomb. The trigger: Binance and the bank. The collapse began in November 2022. A leaked balance sheet showed that Alameda's assets were largely tied up in FTT, the token created by FTX itself. Instead of holding liquid assets like Bitcoin or dollars, Alameda was propped up by its own house currency, whose value depended entirely on the market's faith in FTX. When Binance, FTX's largest competitor, announced it was selling its holdings of FTT, panic spread. traders and customers began withdrawing their funds from FTX. In the world of finance, this is known as a bank run. In crypto, it's even faster. Billions of dollars in withdrawal requests flooded the exchange within days. FTX couldn't pay them. The money simply wasn't there. Customers discovered that their deposits, supposedly safe, had been gambled away. Within a week, FTX filed for bankruptcy. More than $8 billion in customer money was missing. The fallout. The fallout was massive. Ordinary people lost their life savings. Hedge funds and institutional investors lost hundreds of millions. The crypto industry as a whole entered a new winter, with prices for Bitcoin, Ethereum, and countless other tokens plummeting. Trust in centralized exchanges was shattered. Sam Bankman-Fried resigned as CEO, and a new leadership team was brought in to clean up the mess. They described FTX as worse than Enron in terms of corporate controls. There were virtually no proper accounting systems, no oversight, and no separation between the company's funds and Sam's personal empire. In December 2022, Sam was arrested in the Bahamas and extradited to the United States. He faced charges of fraud, conspiracy, and money laundering. His trial in 2023 revealed shocking details: secret backdoors in FTX's code that allowed Alameda to take unlimited credit, political donations made with stolen customer money, and reckless risk-taking on a scale almost unimaginable. By 2024, the verdict was in. Sam was found guilty on multiple counts and now faces decades in prison. From billionaire to inmate, his fall was as fast as his rise. Lessons from the collapse. The story of FTX is not just about one man's greed or recklessness. It's a reminder of larger truths in finance and human behavior. First, trust is everything. Financial systems, whether banks, exchanges, or investment funds, depend on confidence. Once that confidence is gone, collapse is inevitable. Second, hype is dangerous. FTX had celebrities, politicians, and top venture capitalists on its side. But flashy endorsements cannot replace real transparency. Third, history repeats itself. Enron, Lehman Brothers, Bernie Madoff, the details change, but the pattern is the same. Ambition turns into greed, risk turns into fraud, and eventually the system catches up. Finally, regulation matters. The crypto industry has thrived in a gray area, free from many of the safeguards that exist in traditional finance. The FTX scandal was a painful but powerful reminder that without oversight, the consequences can be devastating. Closing Sam Bankman-Fried's rise and fall is one of the fastest wealth-to-prison stories in history. In just 3 years, he went from being hailed as the future of finance to being remembered as one of its greatest fraudsters. His story is a warning to investors, entrepreneurs, and dreamers alike. Success built on deception will always collapse. FTX is gone, but its lessons will be studied for decades. In the end, it proves a simple truth. In the world of money, trust is more valuable than any token, and once it's broken, it can never be bought back. This was Empire of Money. Subscribe for more stories of power, wealth, and collapse.